Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right. Hey guys, it's Mark Eitel here, and this is the Mr. Mortgage Show, and we have a great show lined up for you this week. I'm ready. I am wound for sound. I'm rolling up my sleeves and digging right into the data. Guys, this week we're going to talk about this housing crisis in America. Fact or fiction, right? We're going to dive into the data because we keep seeing headline after headline after headline that insinuates something has to change. And then we think something is going to change. And is it better to wait? Is it better to buy? Should I sell? What's going on? Is the market going to crash? And it all stems from this quote unquote crisis that we're having in the housing market. So I want to dive into that. So we're going to get started here in a second. Guys, if you have questions or comments along the way, call or text 855-462-7292. That's 855-462-7292. I'd love you to participate. Any questions about real estate or mortgage, shoot them to us. You can call or text that number, 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that little envelope icon, that email icon, and you can type your question and shoot it over to Jen, my producer, who is womanning the hotline. And she's also watching for your emails. Guys, she's back there doing it all. She's already running around back there. So we've got that out of the way. That's how you participate. Let's dive into the data, right? So we talked about it. Housing crisis. What does that mean, right? There's no doubt that affordability, it's never been more expensive to buy a home, right? The affordability index is off the chart, up or down, however you read that thing. It's more expensive as a percentage of your monthly income, and it's more expensive just to go out and buy a home. We're in lofty territory. So let's get that out of the way. It's absolutely putting pressure on the buyers. It's harder to qualify, and it takes more of your monthly income than ever before to own a home in this country. Now, back to this concept of a crisis. When I think of a crisis, right, my mind goes to like the border crisis, where there's lines of people trying to get in, but they can't get in for whatever reason. And we don't do politics, but my point is, a crisis in my mind is an overwhelming number of people who are trying to do something, but they can't because of a circumstance outside of their control, right? They're negatively impacted by something. So does that mean that there is an overwhelming percentage of the population who wants to buy a home but can't, right? In my mind, that's where I go when I hear crisis. So we dug into the data, guys. You know, each week I love to roll my sleeves up and dig in. So this data is from the census.gov as well as the FRED, F-R-E-D, Federal Reserve Economic Data. As a matter of fact, you can read this for yourself and just Google St. Louis FRED, and all of this data will pop up. So going all the way back to 1900 in this country, I want to look at what percentage of the U.S. population owned their home, right? Homeownership, there's a crisis. So let's look at that. Is there really a crisis? In 1900, so 123 years ago, 46.5% of the population of the United States owned a home. In 1910, that was 45.9. In 1920, 45.6. In 1930, 47.5. In 1940, it fell to 43.6. In 1950, it was 55. In 60, it was 61.9%. In 1970, 62.9%. In 1980, 64.4%. It fell a little bit in 1990 to 64.2%. In 2000, it was 66.2%. In 2010, 67.1%. 2020, 65.3%, right before the craziness started. Today, it's 65.9%. So guys, in the face of everything that we've been through, with the pandemic, everything that we've been through with this ridiculous appreciation cycle, everything we've been through with all-time, lifetime low interest rates, 65.9, roughly 2/3 of the U.S. population own a home. Now, we just went back 123 years to see that we've been as low as 43%. And I didn't touch on this because it was in between the decade jumps, but in 2004 was our peak at 69.4%. So since 1960 to today, we've bounced around in the 60s and we're at roughly 66%. In my mind, just looking at this data, it seems on average of late, going back to 1960, roughly 2/3 of the population wants to own a home. Roughly 2/3 of the population owns a home. So the 1/3 of people who don't own a home, do they prefer not to own? Would they just be happier renting because they're transitioning for whatever reason? Not everybody wants to buy a home. So what is my point in all of this? Is there really a crisis, or are we just at the maximum of participation in homeownership? And yes, it's more difficult for the guy who waited all of this out or who's just now ready for the first time in their lives to buy. And yes, it still makes sense for all of the reasons we talk about to buy. And guys, if you already own your home, here's another interesting statistic. If you already own your home, none of this matters. You're fat and happy with equity and a low interest rate. So in today's market right now, today, this data was released by, I believe it was Black Knight this week, came out with a data set that shows the outstanding mortgages in this country average less than 4% interest. 3.94 was the data. 3.94% average interest rate on an outstanding mortgage, with a balance of around $252,000 against a median home price of well over $400,000. So the people who own, right, we've established that roughly 2/3 of the population historically since the 60s want to own. They do own. You've never had average interest rates this low. You've never had this much equity. So my point is, if you already own a home and you want to move up, you've got a ton of equity. If you're moving down, you're probably paying cash. And the vast majority of people don't want to sell if they own because they have so much equity and a low interest rate. And that's what it's going to take to bring prices down. And the reason I'm saying that is a lot of people's answer to this perceived housing crisis is we've got to get prices down so that more people can participate. Well, guys, I'm of the mindset that everybody who wants to participate will figure out a way to participate. So I just wanted to touch on that because we have a tendency in this country to be over dramatic about every headline, over dramatic about every problem. And I don't think real estate and housing is any different. So, but anyway, guys, that's my rant. I appreciate you letting me run a little bit there, but you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We're going to dive into your questions. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And friends, if you've got questions or comments, just call or text 855-462-7292. 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Call or text that number, and Jen, who is womanning the hotline, will get your questions on the air. If you prefer to shoot an email, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot her over your questions that way. And guys, all that data from the Federal Reserve and from Census, I'm going to put all that in the Facebook group. And you can find the Facebook group by visiting MrMortgageRadio.com and clicking on the Facebook icon. It'll take you right to the Mr. Mortgage Radio Show page. But anyway, guys, I hope that got the gray matter churning. And again, not discounting the difficulty for anybody who's trying to jump in the market today. I get it. It's never been this expensive. But do we really have a crisis? And that's where I wanted to go with that data. Is my belief is that we're never going to get to 100% home ownership. It's super interesting in that data set from the census, how many states are in the 70s and some are lagging. It's super interesting on a local level to see what the economic influences have on homeownership on a very, very localized level. And I would encourage you to visit the Facebook page if you're interested in reviewing some of that data yourself. Again, go to MrMortgageRadio.com and click on the Facebook link. But hey, I know we got the party started with that, so I'm going to throw it right over to Jen and get some questions on the air. Hey, Jen, who's ready? Okay, go ahead.
George emailed us asking, how much down payment is typically required for an investment property?
Hey, George, that is a great question right out of the box with investment property. And we've talked about it recently. There is a huge uptick in the interest in owning investment property. And George, I'm going to answer your question, but that just kind of got my wheels turning. Last week, my hypothesis was people have so much equity that they've got the house's money, if you will, that they're using to buy some rental properties with. And we've established, right, if my theory is correct, and somewhere in the 60% range is the maximum participation rate for homeownership. And guys, we just went all the way back to 1900, and it kind of looks that way. It's never been over 70. Then a large percentage of the population from a number standpoint, because our population is growing, is going to be renting, right? For whatever reason. So if you have the opportunity to be a landlord and take advantage of some of the loan products, like the landlord loan that we talk about so often, it might be an excellent time to consider being a landlord, even at these elevated values, because there are benefits to owning real estate in all markets. So anyway, George, back to your question. I'm just so wound up because I've got all this data spread in front of me, and that's where I geek out. But anyway, so typically you're going to be required to put down 20%. Now, in some circumstances, you can get away with less than that. In others, it may be a bit more. But if we're talking about residential real estate as an investment property, 4 units or less, using a product like the landlord loan, go into it planning for a 20% down payment. You might be pleasantly surprised that you only need to put 15 down. And then depending on property values and perhaps a credit issue, you might be required to put a bit more down. So right around 20% is typically what we're seeing. But great question. Hey, Jen, toss me another question.
Rebecca wants to know, can I refinance if I just bought my home last year? We should have decent amount of equity. I'm just not sure if it's too soon.
Hey, Rebecca, that's an interesting question. I would love to know why you're refinancing. You mentioned equity, so my assumption is maybe pulling some cash out to make a move, perhaps like we just talked about, and buy some rental property, or maybe you're doing a debt consolidation. So I would be curious to know why so soon, right? Having only owned the property for a year. But if it is to acquire some rental property, it certainly makes a lot of sense to do it, because guys, that's another thing. pulling equity out of one property to go buy another, all you're doing is trading positions. The equity is in now another property. So it's not like it's costing you any money. I mean, I know there are closing costs. I say that all the time. But if you're pulling $50,000 out of this property and putting it down on that property, now you've got the $50,000 in equity. It's just somewhere else. So that may be what you're doing, Rebecca. And yes, you can do a cash out or a debt consolidation refi if you've owned the property for 12 months. To use the appraised value instead of the purchase price when you're looking at how much money you can extract and establishing the value of the property. In the past, you could do it as soon as 6 months, but there are program guidelines for the majority of programs in that scenario that have pushed that back to a year. Now, that's on a primary residence. There's a whole different set of rules for pulling cash out of investment properties with something like the landlord loan. So assuming you're talking about taking it out of your primary residence and you've owned it for 12 months, you should be fine. But I'd love to talk to you more about it if I'm missing something or if you need some additional information. Hey, Jen, toss me another question.
Chris sent us an email. I was on the FSBOzilla site. It's pretty cool. I understand how selling by owner saves money, but as a buyer, does it make sense for me to buy a house from a by owner?
Hey, that's a great question, Chris. FSBOzilla, guys, for anybody out there who's scratching their head, that's the For Sale by Owner book that we wrote and program that we put together to help people in this market who are trying to sell their property without hiring an agent and saving that commission expense. So, Chris, to answer your question, that reason right there, that commission expense saving on the seller side, if you're buying a for sale by owner, it might give them more leeway, if you will, to help you with your closing costs or help you with an interest rate buy down. We've got a family right now in the FSBOzilla program. And guys, the FSBOzilla program is free. We simply want to help you get through the process. And in turn, we'd love the opportunity to be your preferred lender and pre-approve all of the buyers. And we've got a family right now going through the FSBOzilla program. They're taking some of the savings on the commission side and doing a seller contribution to help the buyer lower their interest rate. So now their property is easier to sell. And Chris, if you were buying from a for sale by owner, they may be more willing to do that because they don't have that commission expense coming right off the top. So, and guys, anybody who has questions regarding the FSBOzilla program, the book, how to get your copy of it, give us a call, shoot us a text. I'll walk you through it. We're having a lot of fun with that program. Hey guys, but you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, we are going to keep this train a-rolling. If you've got questions or comments and you want them on the air, call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline. She'll get your questions on the air. And guys, you know it. You can shoot us an email too if you prefer doing that. Head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page. Click that email icon and you can send her your questions that way. But this is my favorite part of the show. Love your questions and comments, so let's keep them rolling. Hey, Jen, do you have a question ready?
Andrea sent this. If I decide to switch from for sale by owner to using a realtor after some time, Are there any complications or things I should be aware of?
Hey, Andrea, brilliant question. A lot of people do that, right? They'll try themselves. I mean, that's part of the reason we wrote the book, to make it easier to do it yourself. But if you get through the process and you throw your hands up and you decide it's time for an agent, we can introduce you to somebody in the Really Great Agent Network, or you can choose somebody on your own. That's irrelevant. But yes, it's a super simple transition. The agent may be able to use some of your collateral material, like your photography, if it's good, and you could save a bit of money that way. But really, the big thing is just canceling that for sale by owner listing in Zillow. If you followed the FSBO Zillow guide, you would have put that live listing as a buy owner on Zillow to get the exposure. You would just cancel that. They would have all of the forms ready for you. You sign with them, they stick it on the MLS and take it from there. So it's a very smooth transition should you choose to try it on your own. A lot of people do that. They'll give themselves a 30-day window and then they'll turn it over to an agent. And if you need help with that, or you want to vet an agent or just be introduced to some really great agents, just reach out to us. I'll be happy to get the ball rolling for you. But great question. Okay, Jen, throw me another question.
Lydia wants to know, how does buying a home with a cosigner work? It'll be my first home, and my mother says she'll cosign.
Hey, Lydia. Awesome. I'm glad Mom is helping you. You are going to be one of the 66%, so I'm super excited for you. It's an easy process. We're going to take both of your incomes and both of your debts, and the credit scores for both people will be considered, although the lower of the two middle scores becomes the grading score, if you will, in underwriting. But most often where people get a lot of benefit from the cosigner is that additional income. And then you can buy the property as your primary residence, and Mom would be considered a non-occupying co-borrower just to help you over the hump. So that's traditionally how it goes. There are other ways that Mom could help you buy that first home, but from the cosigner standpoint, that's typically how it's structured, and that's what you can expect. Great question, though, and I am so excited for you because buying your first home is one of the big, exciting milestones in life, and I know it's going to be a great experience for you, so that's awesome. Hey, Jen, throw me another question.
James sent us this one. I think a reverse mortgage may be the answer for me, but my friend says it's a scam. I'm trying to figure this out. In your opinion, what is the downside? I'm 81 and I don't owe anything on my house. Thank you both.
All right. Hey, James, let's slow this down for a minute because, guys, the reverse mortgage is so misunderstood, and it requires some additional conversation. And it's not a scam, James. It's not a scam. It's not right for everybody, but it's not a scam. So in my opinion, if there is a downside, it's that your equity position in your property is going down over time if the balance of the reverse mortgage grows faster than the property appreciates. Because the way a reverse mortgage works, guys, for anybody out there who's thinking about it, you have parents or friends who are considering it, it's a great opportunity to access the equity in your home while staying in your home and not having to make a monthly payment. Now, that's not to say you don't have to pay it back. And that's the one scam alarm that goes off for a lot of people. They say, well, it's too good to be true because so-and-so told me I don't have to pay it back. Well, that's not true. You do have to pay it back. Anytime you borrow money, unless apparently it's a student loan, you do have to pay it back. So the way the reverse mortgage works, because you're not making a monthly payment and reducing that balance, each month you're accruing a little bit more interest. So your balance is growing over time. And the reason I say that that could be a downside is if your goal is to leave a bunch of equity to your heirs, well, you're going to leave less equity. You mentioned you don't currently have a mortgage, so all of the equity in your home theoretically now would be passed to your heirs. That's the biggest thing that I see people having a hang up about the reverse mortgage is they want to leave the money to their kids. They want to pass down this nest egg. and it's a pride thing. We all want to do right by our children, right? We all want that, handing the torch over, if you will. So a lot of people, because of that, they resist it, but then they live in frustration and desperation in some instances because they can no longer afford their lifestyle. And James, if any of this is resonating, it is not a bad thing that you outlived your savings. My God, man, congratulations for living a long, healthy life. And most of the time, we find that when the children and the parents come together and we all get together and have a conversation, most of the time the children don't realize how tight things are for their parents financially, and they are more than receptive to support the idea of the reverse mortgage. So, guys, you do have to pay the mortgage back. It's paid upon your death or you leaving the property permanently, and that could be a sale. That could be a transition into assisted living. And then whatever the balance is at that moment, if the property's sold, it's like any other lien. The lien is paid off. The remaining equity is passed to the children. So I would encourage you, let's do this. I would love the opportunity off the air to take some time with you and just walk through your particular circumstance. I just need I know your age. We need to do a property value report to see how much equity you could access. And then in the reverse mortgage package, there is a projected appreciation cycle and a projected balance growth cycle. So you can see pretty clearly after 10 years, after 15 years, after 20 years, this should be my equity position. And then you've got all of the data. It's not a Facebook feed or it's not your friends at the clubhouse telling you it's a scam. You can make the decision for yourself because your friends don't know what your circumstance is. So exhale and let's have a conversation because it's not the big scary monster people think it is. As long as you keep the taxes paid and the insurance paid, you're not going to get booted out of your home. And if ultimately you owe more than the property's worth, your kids aren't going to have to pay the negative equity position because it's a federally insured loan. So clearly I'm passionate about it, but I say it all the time. It's not right for everybody, and it's just a tool. A tool can build, a hammer is a tool, and it can build a house, and it can also tear a house down. So you got to make sure it's the right tool for the job. But hey, let's do this. Let's have a conversation off the air. I'll have Jen reach out to you. We'll set something up, and I'll walk you through the pros and cons of your particular circumstance. So great question. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. On the other side of this break, we'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And you heard the man, 855-462-7292. That's the Anytime hotline. You can call or text that number, or you can head over to MrMortgageRadio.com. Scroll to the bottom of the page, click the email icon, and you can send Jen your questions via email. And guys, that's where we put all of the data each week that we talk about on the air. You can find everything at MrMortgageRadio.com. Anyway, let me throw it over to Jen for another question.
Mitch wants to know, my son works for a cannabis dispensary, and our bank is telling him he can't get a loan because of some laws about weed. It's totally legal here. Are there any options for him?
Cannabis. I'm kidding. Interestingly enough, right, the whole legalizing marijuana happened on a state level. And technically, federally, it's still illegal. And federally is how the banking systems are regulated. So that's where the hang up is coming. That's loosening up. And it's just the states got ahead of the federal regulators, and the federal regulators is where the challenge is. They regulate the banks, and they also regulate at a federal level the marijuana laws in this country. But, 2 years ago, that was much more of a challenge than it is now. So I want to encourage you, reach out, and we might be able to help with that because we do have cannabis lenders. We've been involved in this in the past. When the legalization first happened and everybody was scrambling, we were lucky enough to have lenders in our portfolio that would fund mortgages for employees and owners of dispensaries and other ancillary businesses around the cannabis space. So I appreciate that question. You're not alone, though. It's super, super confusing. But thank you for that one. Hey, Jen, throw me another one.
Here's an email from Isaac. I'm concerned about negotiations. How can I ensure I'm getting the best deal for me when selling a for sale by owner?
Wow, that's a tough question. I don't really know how to answer that because I don't know how you define best deal for you, right? I guess maybe that's where you start. Maybe you start by saying, okay, the ideal offer looks like this. X amount of dollars for a sales price, no more than Y amount of dollars for a seller contribution, this number of days for closing the transaction. Do you want a post-closing occupancy clause? Kind of map out what's ideal for you so when you are negotiating, you can hit all of those points because, price is one thing. How quickly you can close the transaction is another thing. And faster is not always better. Sellers sometimes want more time to make that move. So my suggestion would be map that out on paper so when you're in the heat, if you will, of negotiation on a particular offer, you can make sure that you're addressing all of those points. Maybe if you don't get everything you want on one point, but you get more here than you expected, maybe it all balances out. But that would be my encouragement and my suggestion because I don't know how to answer that without understanding, is your ideal situation achievable in your area in this market? That's another thing. Some people have a misconception about the value of the property. We all think our baby's the prettiest, and we often think the same thing about our homes. So, I have no advice about how to get $800,000 for a $500,000 property, but the other suggestion would be just kind of paint that ideal picture and then work back towards that when you're negotiating. But if you want to have a deeper conversation, just call me. I'll walk you through it. Maybe we can, kind of map something out together that you might find helpful. But I appreciate that question. Hey, Jen, toss me another question.
Paul wants to know, are there any true no-income documentation loans anymore? This will be for my personal house, not a rental. Can I still use the landlord loan? Thanks.
Hey, Paul, that is a brilliant, brilliant question. And you don't want to use the landlord loan and then lie on your application that you're not going to occupy the property. Now, if you're buying a fourplex or a duplex or a triplex and you're occupying one of the units, that's a whole different scenario. You can do that. But one of the disclosure documents and one of the requirements in the landlord loan application and closing document pack is that you are attesting to not occupying this as your primary residence. And the reason that is because the income that was underwritten for that loan was the rental income from the property or projected rental income. So not your personal income. That's why it's a requirement that it be truly a rental property. And occupancy fraud is a real thing, guys. They're auditing files, and there are people who just go to addresses to confirm that the house is indeed a rental property. So I can't stress strongly enough that you do not want to go that route. Now, here's something that's encouraging. There are some true no income, no employment verification loans that are available. They're typically called the community loan program or some variety of that name. And how it works is if your credit score meets the requirements and your down payment meets the requirements, and you're typically looking at somewhere between 15 and 25% down, and you have 12 months worth of reserves, meaning enough assets to make the property payments for 12 months. So if you had $2,000 a month in principal, interest, taxes, and insurance, and once you bought the property, you had at least $24,000 left over for reserves, then there are programs that are no employment, no income verification. We're verifying assets and credit. And that program has a higher interest rate than conventional financing. It's pretty close to the interest rate of the landlord loan, but it allows you to do what you're wanting to do. You can buy a primary residence. You're not committing occupancy fraud, and you're not having to disclose your employment or your income information. And that loan program goes up to $3 million. So not a lot of people are aware of it. It exists, and I would highly recommend that before you considered occupancy fraud, because any fraud is, you don't want to go that route, brother. But I appreciate the question. I hope that helps, and I would encourage you to reach out if you need more info. All right, Jen, throw me another question, would you?
Nicole sent this. A few weeks back, you talked about a way we can sell our house and get an extra 2 months to move. Can you explain that again? I looked through your podcast episodes, but couldn't find it.
Yeah, that's a great question. What I was talking about was post-closing occupancy. And how post-closing occupancy works is the buyer allows you to remain in the property after they buy it for a pre-negotiated amount of time, right? And if they're buying the house as their primary residence, that term can't be longer than 59 days. If it's longer than 59 days, it won't qualify for them buying it as a primary with a mortgage. They would have to buy it as an investment property. So that's usually the max on post-closing occupancy, is that 59-day period. But you can negotiate in your sales contract that you need that 59 days to move out of the property, then buying yourself some time to make the transition into your new property a little smoother. And we see a lot of that, guys, but it has to be written a specific way, the language, in order for the buyer to qualify for their mortgage. And that 59-day rule is hugely, hugely important. So I hope that helps. Hey guys, you hear the music? Man, oh man, we've wrapped up another week. Where does the time go? Guys, MrMortgageRadio.com. If you need us during the week, MrMortgageRadio.com is where you find everything, including all of the data that we talked about this week. All right, guys, Jen and I are out of here. We'll see you next week, same time, same station. Find us at MrMortgageRadio.com if you need us. Otherwise, be good. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.